In a previous video, we covered how Ecom Express collapsed from planning a 7,300 crore IPO to getting acquired by Delhivery for just 1,407 crores, a staggering 80% drop in valuation. What happened? Join us as we delve deep into the high-stakes worlds of mergers and acquisition, where today's leaders can become tomorrow's cautionary tales. Mergers and acquisitions, M&A for short, are the ultimate power moves in business. Instead of growing slowly, companies buy their way to the top. A merger is when two companies combine to form one, like equals joining force. An acquisition, that's when one company takes over another, sometimes friendly, sometimes hostile. It's about market share, technology, talent, and sometimes survival. In the corporate world, M&A isn't just strategy, it's war. All large tech companies are notorious for acquisition practices. Just look at Facebook's acquisition of Instagram and WhatsApp, or Google's acquisition of YouTube, or Elon's acquisition of Twitter. Now, the question is why companies don't just build everything themselves in house? Like, why did Facebook buy Instagram instead of creating a copy? Or why did Disney scoop up Marvel, Star Wars, and Pixar like they were building the ultimate content empire? Simple: speed, power, and leverage. Let's break it down. To grow fast, really fast, that's their number one goal. Building from scratch takes years. Acquiring someone who's already crushing it, that's an express lane to expansion. You get the market, you get the customers, the product from day one. It's not cheating, it's strategy. This happens all the time, especially in tech. Point number two: to kill the competition quietly. Sometimes it's just better to buy your rival before they become a threat. Coca-Cola did this to Thumbs Up in India in the early 90s. HUL tried to do the same to Marico in India and failed miserably. Instead, their hair oil brand Nihar was eventually acquired by Marico. Number three, to get talent or tech IP or both. Some acquisitions aren't about the brand, they are about the brains. A company might spend hundreds of millions of dollars just to acquire a 20% team that's solving a really hard problem. It's called an acqui-hire. And yes, it's a thing, especially for deep tech R&D type businesses. Point number four, to save a dying business. Sometimes it's less of a strategy and more of a rescue mission. If a company that is struggling has something valuable, some assets, some IP which can be salvaged, like a strong brand or a loyal user base, it might get acquired at a discount. Think of it like a second life. That's exactly what happened with Ecom Express. Point number five, synergy, aka एक और एक 11. This is the classic MBA answer. The idea is if we join forces, we can cut costs, share resources, and make more money together than we could do it apart. Sounds great when it works, but it's not always so rosy and always not so elegant. M&A is how the big players stay big and keep growing bigger, and how some small players cash out. It's not just about buying companies, it's about buying time, attention, and advantage. Mergers and acquisitions can make legends, but if go wrong, they can make disasters. Let's talk about some Indian M&A deals that absolutely nailed it and others that didn't. So, when it went right, the biggest example was Flipkart and PhonePe in 2016. What started as a small bet turned into a huge fintech goldmine. Flipkart bought PhonePe when it was just an idea. Fast forward a few years ago, PhonePe becomes India's UPI beast. Now, it's a standalone juggernaut worth over $12 billion itself. And not just that, they're planning to do their own IPO independently. That's how big it is. And this is one of the best examples of an M&A went right. So the lesson is sometimes your side hustle becomes your crown jewel. Point number two, Zomato and Uber Eats India in 2020. Zomato didn't just beat the competition, they bought it. Uber Eats was bleeding cash in India. Zomato saw the opportunity. No cash, just equity. In return, Zomato got Uber's entire customer base, delivery network, and a far more cleaner battlefield than it was before. That's how you win without fighting. This is the ultimate master plan and coming straight out of a Game of Thrones playbook. So now, after we've looked at two successful examples, Now let's look at examples when the M&A process went terribly wrong. The most notable example being Kingfisher and Air Deccan, the deal that should have never taken off. Vijay Mallya bought Air Deccan to expand Kingfisher's reach into budget travel. But Kingfisher was premium, Air Deccan was low cost. The cultures clashed, the customers didn't accept it. It was a huge mess in terms of the customer expectation, the culture of the companies, the finances, everything spiraled and completely went haywire. And soon, both crashed. It wasn't synergy, it was absolute chaos. Example number two, Snapdeal and Freecharge. The only person who made a boatload of money in the Freecharge acquisition by Snapdeal was Kunal Shah, a $400 million deal which eventually turned to dust. Snapdeal bought Freecharge to compete with Paytm. It was a bold move, but they didn't scale it, didn't integrate it, and eventually sold it for just $60 million to Axis Bank. That's a $340 million oopsie. So moral of the story is, if you buy something hot, don't let it cool off. M&A isn't just about business, it's about matchmaking. If the cultures don't click, the numbers won't either. But when it works, it's an absolute masterstroke. So, the next time you hear about a $1 billion acquisition, ask yourself this question: is this a potential Flipkart move where the synergy could take both companies ahead, or a Kingfisher crash? In the world of business, you're either building or you're buying. And if you're doing neither, you're essentially the one which eventually gets bought. So I hope you like this video. Share it to one of your friends who would get more value from this and learn more about this if he's in the right stage right now. So looking forward to seeing you in the next video.